Hello and welcome to this pricing course. In this first lesson of the module on strategic pricing, we'll talk about the techniques that have traditionally been used to define prices.
Let's start by understanding why work on pricing strategy. Some people will say it's to make more money, and they are right. Others, using slightly more sophisticated language, will say it's to be more profitable. But what is profitability really? Is profitability about selling more, or is it about selling with better margins? To truly understand what it means to be profitable, let's look at an example. Brothers John and Peter each receive an inheritance of $500,000. John invests his money in a business that generates $1 million in annual sales, yielding a net profit of $100,000 per year. Peter, on the other hand, invests in a business that generates $250,000 in annual sales, with a net profit of $100,000. Which business is more profitable? From a margin perspective, meaning the relationship between profit and sales, Peter's business is much more attractive than John's because it has a margin 4 times higher. However, from a turnover perspective, meaning the relationship between sales and investment, John's business is more attractive than Peter's because it has a turnover 4 times higher. When we combine margin and turnover into the concept of profitability, we see that both businesses are equally attractive. Both generate a net profit of $100,000, which divided by the $500,000 investment results in a 20% return. In John's case, this return comes from multiplying a 10% margin by a turnover of 2, while in Peter's case, it results from multiplying a 40% margin by a turnover of zero point 0.5. Both businesses fall on the same profitability curve, which is built by combining margin and turnover. John's business is turnover intensive, while Peter's business is margin intensive. This doesn't mean one is better than the other. They are simply different but equally profitable. But even within a single business, there can be products and services with high margins, like Peter's business, and others with high turnover, like John's. This doesn't mean that some products are better or worse than others. It simply means they play different roles in the portfolio. Some are margin intensive and others are turnover intensive. Now that we have understood the differences between margin, turnover, and profitability, let's see why traditional methods companies use to set prices don't work. There's a first group of companies that want to be like Peter's business, aiming for high margins by setting prices as the sum of cost plus a desired profit. This approach has two problems. First, prices might end up outside the market if the company's costs are higher than those of competitors. Second, if costs are lower than the competition's and the desired margin isn't very ambitious, this could lead to low prices that leave money on the table. But this logic also creates a mathematical paradox. Using unit total cost to set the price, that price determines the level of sales, and that level of sales in turn affects the unit total cost. If sales drop, costs goes up, price increases, and sales drop even more, creating a vicious circle. There's another group of businesses that prefer John's model, seeking high turnover. These businesses tend to please the customer at any cost. In consumer markets, this practice leads to excessive price promotions, turning customers into habitual bargain hunters. In investor markets, pleasing the customer means giving into haggling. When this happens, customers learn to buy only when we are willing to negotiate. And worst of all, word gets around, and even customers who didn't haggle before learn they can now. Finally, there's a third group of businesses that also like John's turnover intensive model, and they set prices solely based on their competitors' prices. This practice creates serious problems because by comparing only prices and not the price value relationship, businesses risk comparing non equivalent solutions, possibly leaving money on the table if the product is better than the competition's, or being uncompetitive if the solution isn't as good. So, if traditional pricing methods based on cost, pleasing the customer, or following competitor prices don't work, how should prices be set?
We'll cover that in the next lesson where we'll talk about value-based pricing.